As a full-time trader, I'm constantly making plans and adjusting of how I'm going to make money this week. And I wanted to take you along during my planning session to show you exactly how I'm planning on making money for this week in the markets. Let's dive into the charts. So let's start with SPY. That's the stock that I trade the most. I'm a big options trader. And right now on SPY, the bulls are fully in control. And I would say they're going to remain in control unless we start getting below 565. So we've got the line in the sand for the bulls. It makes it very simple. I am full buy the dip mode at the moment. So there's a few questions that I need to answer to be a successful trader. How much higher is this thing going to go? Because I've already answered the first question that we're bullish. So how much higher is this thing planning on going? If it does pull back, how far is it going to pull back, and where am I planning on buying the dip? Let's answer those questions here. So again, very first thing, we are in a bull trend. So I am looking bullish until otherwise proven. The second question is, how do I know how much higher this thing's going to go? When is this thing going to look to possibly turn around? Well, on that, I've got to zoom in on a smaller time frame, and I've made an up channel here on an hourly chart. This seems to be respecting it extremely well. And so I would imagine these markets are going to keep on cranking bullish, most likely to the top side of this up channel. If we break the bottom side of this up channel, that's going to be my first sign to let me know that this thing is reversing and it's ready for the drop. And so that'd be a great day trade, short-term swing trade on the way down. It's not going to be very strong-lived because, again, the markets are bullish. You want to be making money with the momentum, and right now the momentum is to the bull side, not to the bears. Again, doesn't mean that it can't have a bear move. Not at all. It could totally make a bear move, and I'm expecting it to, and I'm going to use this hourly channel to give me an idea to time that up when these bears are stepping in. But how will I know it's time for the bulls to take back over again? Well, looking at this chart, I can clearly see this key level sitting right around 575 on the charts. It's a very strong support. It's working back into the EMAs. It makes a heck of a lot of sense. We broke through it strongly. It's probably going to continue higher, but at some point, most likely this week, we're going to get some selling and we're going to play our way back into 575. So with that information, I start looking at going, okay, 575 is my first spot to look for signs that the bulls are here. I don't have to just press the buy button as soon as it gets there. I can watch for clues to let me know that the bulls are taking over, and that's exactly what I'll do in this area. That's why I've got alerts all through here to notify me so I can go out and live my life, come back to the charts when these alerts go off, trade, let the markets play out, go to targets, whatever they want to do as I'm out living my life instead of sitting in front of the computer all day long. So 575 is my first support, and then I also identify the EMAs. So it could pull all the way back into like 570. Well, if I go and look at my broker and look at where the option strikes and open interests are at, if you guys want to learn more about option strikes and how I use the open interest of those strikes to help me to choose better levels, I had a short clip at the very end of last week's video showing exactly how I do that. I will tag that video down below in the description if you want to go back and rewatch that. But looking over my broker so far, the big option levels that I am looking at for this week, 575 is a big one, and it happens to match up with that support. So this is where I will most likely be getting in long this week on these pullbacks. Around 575, I believe, will be a very strong buy demand. If 575 doesn't hold for whatever reason, 570 is the next on the list to get bought up, and that's around the 20 EMA. So both of these levels, I will be looking for the bulls to step in and take this thing back up bullish and most likely make a new all-time high. If I'm looking at the call side of the open interest, I see a huge amount of strikes sitting around 585 for this week and 590. Now, there's another huge strike sitting at 600. I don't think we make it there this week, but most likely within the next few weeks, if these bulls continue to party, that's where it's going to want to go. So I have a better idea now of how exactly to time up when the bulls are losing strength and the pullback is most likely to come. And I have a really good idea now of the location where I expect the bulls to step in. So with this information, I can start making a game plan for this week of how I'm planning on making money. I'm most likely going to have some bearish day trades on the way down because I don't think holding this overnight is going to have that much momentum to it for the bear side. Once we break that channel, day trade it down, make some easy money day trading bearish, and then take profits once it starts getting into that 575 level. Look for my bullish setup, and then see if these bulls step in around that 575 area and simply ride that momentum. It's simple, easy money. That's what trading is all about. But the problem is 99% of people cannot diagnose a chart. They will not plan ahead. They are always reactionary to what's going on. And you have to flip that script. You cannot be like the crowd and make money successfully in the markets. You've got to be different. You've got to plan ahead and stick to that plan. Keep those emotions out. Don't FOMO. Don't get scared. If the markets just go screaming bullish for the first 2 days, great. The plan is still intact. Let it pull back and then buy it. I can day trade it up bullish if I want. But jumping in up here after 5 bull days in a row is not a high probability trade. The odds of it continuing much higher are not very high. Compared to a dip back into a buying area, jump in there, that's a much easier trade. Because as this thing bounces, I'm in the green. So if it starts to reverse up here, I'm already profitable. I can get out for a win instead of getting in up here. And if this starts to reverse, now you're dealing with emotions of I'm losing on this trade. It should still go higher, but it's reversing. It's a lot harder trade. So the key is plan these things out, understand how to read the charts, understand how to trade. This is trading, my friends. Trading is not clicking the button. 90% of your trading should be planning and 10% of actually clicking the button. So don't fall trapped to that because the markets are open. It feels bullish, feels bearish, and you're going out and you're just kind of throwing stuff at the wind and you're just hoping something sticks. Don't be like that. You'll see so much more success in your trading if you can simply pick your levels and trade when those levels come out. If the markets never pull back to 575 this week, I'm not going to trade it. I'm going to go live my life and do something else, and I'm going to wait for the easy trades. I'm going to let the markets come to me instead of me chasing the markets. That's the key to having so much more consistency in your trading. So the option markets is let me know where the big levels are at. The chart is correlating with those big option levels, and I've got a really good idea of where these bears are most likely going to step into the market at around 585 to 590 this week. If you would like to understand more about options, I taught our All Access Pass members in the real life trading community options last week, and I'm actually going to include a small clip of that at the end of this video. So just stick around, watch that, and I hope it adds value to your trading and helps you see more consistent returns. If you would like to come check us out at Real Life Trading, you have a 2-week free trial, no commitment. Links down below in the description. The last ticker that I'm going to spend some time looking at for this week is Tesla. In my opinion, Tesla broke its bullish structure with a massive gap, and the buyers really weren't all that excited off of the 200 EMA. It is a good buying spot. It looks really good, but I'm going to continue to sit back and wait at the moment on Tesla. I would imagine on Tesla, we're going to be seeing some bull moves over this week or two. But once we start playing back into this 240 to 245 range on Tesla, I would think that the bears are going to try to step in and push it down. From there, we'll see what happens. But expect bears to be in this area and bulls to be taking profits in this area, understanding that that's where these bears are sitting. It could go lower. I don't think that's going to happen. Most likely, it's a chop sideways this week. If not, some bulls should be stepping in and pushing this back up into the gap fill area, and we'll see where the bulls go from there. But again, understanding who's in control will help you be way more successful in your trading. In my opinion, these bears are stepping in pretty hard, and I think they're going to wait for their entries on a retest back up and try to push this back down. So if the bulls are here, they will fight through this area and push it back bullish. Once that price action happens, bull, jump in, momentum will be very, very strong to the upside. But for right now, I would imagine bears will be stepping in and at least rotating this back into like the 210 to 200 range again on Tesla. So there you have it. That's what I do every single week in the markets. I make a game plan. I look at what the charts are telling me, where the sentiment's telling me, where the options are showing me to go. And then I put alerts out there and I trade those areas. That's the key to consistent trading. Now enjoy this video about the basics of call options that I taught last week to our All Access Pass members. See you next week, guys. Because we're about to dive into calls right now even more, and hopefully it makes even more sense. So let's give this example of call options. Maybe someone has heard this analogy before.
But I think there's one more slide on this. Yeah, there we go. All right, we're buying a house. Whenever you go to buy a house, you're going to put earnest money down. That earnest money enters you into that contract. That's your premium. That's the cost of the option, so to say. You agree to buy the house for $300,000. That's what your strike price is on an option. And you have 3 months to close on the house. That's your expiration date. Okay. So you enter into this contract to buy the house. You agree to pay $300,000 for it. It doesn't matter what happens to the value of the house in the meantime. You have to buy it for the price you agreed upon, right? As long as that contract stays valid. You spent $5,000 for the enter this contract. That money's gone, right? That is, you pay that to the owner, and whether you buy the house, that goes towards the contract. If you back out, that money goes towards the seller. It's gone no matter what, right? There are two scenarios, so I hope you guys like my artwork. Across the street from this house, there's an empty field, and there's two options that are going to be built there. They're either going to build a beautiful park or they're going to build a waste transfer facility. One option is going to increase the value of this house by 50,000, and one option is going to decrease the value of this house by 50,000. We don't know which one. We entered into the contract, and cool. We have 3 months and over the to buy this house. And let's just say that scenario number one comes into play. Well, they announce they're going to go ahead and build the park. Instantly, this house theoretically goes up by $50,000. So now you own an asset that has a lot of value. You have a contract that allows you to purchase this $350,000 house for 300 grand. You can go ahead and purchase this house for $300,000 and instantly have $50,000 in equity. Or you can decide to go to someone else and say, hey, who wants to pay me $10,000 cash to buy my contract from me? And they get value because yeah, that's going to cost them 10 grand, but they get to buy a house that instantly has $50,000 equity. So really, they're coming out $40,000 ahead. Still, it's a win-win on both sides, right? That all makes sense. What if scenario number two comes out and they decide to build the waste transfer facility? This house immediately drops by 50 grand. So now you are you have a contract to pay $300,000 for this house that's only worth 250K. That sucks. So you have a few options. You can go ahead and just buy the house and you'll be underwater. Okay, no big deal. Maybe eventually the house will go up and you can make some money on it. Or you can back away from the deal. You'll lose $5,000 in your earnest money, but it's better than being underwater 50 grand. Those are your scenarios. This is exactly how call options work. You get into a contract to potentially purchase a stock at a specific price. That's your strike. Okay. So again, if that, I'll go back to the same analogy. If the stock's sitting at $100 right now and you buy the 110 strike calls, what are you doing? You are in a contract to be able to purchase this stock at $110 by expiration. So you have a certain amount of time for this contract to be valid. It could be 30 days, it could be 100 days, it could be 300 days, it could be 3 days. You get to choose that. Okay. You had to pay some money to enter into this contract. That's your premium. So let's say you spend $1,000 to buy this call that allows you to buy 100 shares at $110. The idea behind this is you're planning on the stock to go higher during the next 20 days. So you buy this that has an expiration of 30 days. And over the next 20 days, sure enough, this stock just screams to $150. So you could exercise this and say, yeah, broker, let's go ahead and buy those shares at $110 as our contract says we could do. Or you can do what 94% of the contracts and options happen. You can flip it to someone else. You can go, hey, person out there in the stock market world, I own a contract to purchase this stock at $110. The stock is currently trading at $150. I paid $1,000 for it. Who wants to pay me $2,000? It'd probably be a lot more than that, but let's just say that for this instance. Who wants to pay me 2 grand to buy my contract from me that allows you to buy this stock at $110, even though the stock's at 150? A lot of people are going to want to do that, and you can turn around and sell that contract without you ever having to buy the stock or do anything, and you just made $1,000. You just doubled your investment right on that, and you didn't have to do anything. You never bought the shares. You just simply bought a contract to buy the shares at 110, and then the stock rampaged, and you flipped that contract to someone else. They're getting a great value because now they spent $2,000 to buy a stock that's you can buy it at $110. It's currently sitting at 150. Again, I know the math that the option would be a lot more expensive, but you get the point, right? It's all about the theory. Or you could go ahead and just exercise that and go ahead and buy that stock. So you don't need the money to buy the stock. You just need the money to enter into the contract because you don't have to buy the stock. You can close out of that contract for a profit or for a loss without ever having to buy the shares. So this is a really cool thing because let's say you only have $500 in your trading account. Well, it's going to be pretty tough to make $1,000 on a $500 account, right? You can't afford to buy that many shares to make that kind of money. But what if you entered into a contract to buy 100 shares? Well, those 100 shares would cost you $5,000 to purchase those. You don't have $5,000. You only have $500. But that call option to buy that, control 100 shares of this asset, $5,000 worth of these shares, is only going to cost you $300. So you could use this option to leverage your $500. You get to control the money from these 100 shares without ever having to spend the money to buy it. So if the stock rampages up, you get all the profits of owning those 100 shares without having to spend the $5,000 to do it. And if the stock dives down, you don't have the risk of owning the $100. The worst you can lose is your amount that you paid. So you have a very limited downside, but your upside is infinite.